And we're live.
Hunt Lawrence.
All right, here comes Hunt.
Welcome to Telltales, an investing podcast hosted by Hunt Lawrence, Jason Wallace, and Mike Nicoletti. Each week, we discuss topics ranging from geopolitics and macroeconomics to energy and technology. You can sign up for our newsletter at telltales.us. That's TELLTALES.us for additional data and content you can use to follow along. The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
I think we'll start out with oil first. Oil is in a decline. In the price of oil, there's a risk premium, and the risk premium has gone down. And we hear about that from every news source we look at. So it's good news for the world, not necessarily good news for the price of oil. Again, on Exhibit C, there's at least 4 million barrels of surplus, even with the increase in demand. And most of that surplus is with Saudi Arabia and the Emirates, Abu Dhabi. And the concern is that a Saudi official confirmed street gossip that the Saudis, despite Gaza, were still negotiating a deal between the United States, Israel, and Saudi Arabia, have Saudi Arabia recognize Israel and exchange ambassadors. So the expectation is that if that gets concluded at some point in the next month or two, some amount of the 2.5 million barrels a day of Saudi crude that is being held off the market will go on the market. So rather than think about $120, we're down in the mid 70s. Don't think there's any set of circumstances where the Saudis want to see a price, Brent, which typically trades a couple of bucks more than WTI. Don't think they want to see a price in the 60s, but I'm knocking wood as I say that. In terms of natural gas, the chart on Exhibit B makes 24 and 25 look pretty good. Reduced surplus of supply over demand. The two things that help demand are power, and the power demand has gone up 2 Bs a day the last 2 years, and it flattens out here. Hopefully in 24 and 25, there'll be a little more uplift. And then LNG predicted here to only go up 1.5 Bs a day, that some other projections say 2 Bs a day or more. We may need that improved demand from power and from LNG, because that dry gas production estimated 102.5, 24, that's currently running 103, 104. So that's kind of discouraging. If you look at the table just above, the increase from 21 to 23, 9 Bs a day, or about 4.5 Bs a day per year. Half of it was from the Permian, which is associated gas. In an odd kind of way, high oil prices means more associated gas from the Permian. Go to the top set of numbers. Our largest source of gas is the Marcellus, which is flat because it's kind of pipe constrained. The Haynesville has grown, and the Permian has grown, and all other is expected to go down a bit. The future strip is $3.50 for 24, $4 for 25. Hopefully those numbers will be what the way the markets work. On those prices, if you just slide to 21, it averaged $3.70 at 22. 31 is close to $6 now. What in the world happened? $3.70 to $6 down to $2.80. It was pretty much Europe and Ukraine feeling that LNG prices would be very high, and that would pull up U.S. gas prices. LNG prices and the internal prices in Europe got as high as $60. But as the Europeans made it through the winter, they came down, and those prices now, with European gas storage full, those prices now are $14, $15. So, the Europeans made it through last winter. The expectation is they'll make it through this winter. So the gas market is fall considerably. Exhibit A, which we don't yet have the deficit numbers for 23, but they've been announced. It's somewhere between $1.7 trillion and $2 trillion to spending, depending on how you account for forgiving student loan debt. But there are a lot more than $1.4 trillion. And the House leadership under the new speaker is insisting that special emergency expenditures like Israel expenditure reduced somewhere else. That bill will go into conference with a Senate bill that will include probably Israel and Ukraine, as well as border security. And the conferees, the House and Senate conferees, will have to work it out. But it is a good sign to have at least one of our bodies that govern us insist that there's got to be some limit to the amount of money that's spent. I'd like to, since it's kind of oil and gas related, go to the Antero page. That was the one page that got updated last week. It's page 12. The three gas companies here, Antero is totally Marcellus, EQT is totally Marcellus, Chesapeake is about 60% Marcellus and 40% Haynesville, and Antero Midstream is here as a comparison. Antero Midstream's operation is entirely transporting, gathering, and processing Antero's gas production. Antero Resources owns about 31% of Antero Midstream. The purpose for having it here is to show how midstream and upstream are different. Midstream isn't impacted by commodity prices as much. And so the free cash flow in Antero Midstream is around $600 million. At today's gas prices, the cash flow in Antero Resources is, which is all upstream, is around $600 million. If gas pricing just goes up like 50 cents, that free cash flow goes to $1.2 billion. And the Antero Midstream free cash flow at $600 million stays more or less the same. You can see that Antero Midstream trades for 15 times free cash flow, which seems like a full price, but a dividend yield of 7% because it pays a lot in dividends. As you can see, their free cash flow is $600 million. Their dividends are $400 million. In Antero's case, out of $600 million, they buy in stock. They don't pay a dividend. So they're both in the same range times free cash flow. But of course, if the price of gas is going to be 50 cents higher next year, Antero's free cash flow goes to $1.2 billion. So it's a different investment. It's run by the same management. Antero Midstream really doesn't have separate management. And Antero owns a third, but it is a good contrast of the difference between midstream and upstream and the impact of commodity price on that. The other thing I want to do, and I want in a preliminary way say, Mike and Jason, Diane, everyone else who's on this call, I'm going to make a comparison here, but please don't go out and act on it. If you go to page 11, the EOG isn't updated, but when we update it for the third quarter, it'll be about the same. EOG has no debt and it's trading for $75 billion. And it produces, doesn't say on this page, but if you took the daily pricing and you convert it into BTUs, BTU is equal to about 1 MCF. It's 2.1 trillion BTUs that they produce. If you go to EQT on page 12, their production is now about almost 6 Bs a day. And it's almost all gas, or it's gas and NGLs. And half the NGL barrel is ethane, which trades for less than gas. So just considered 100% gas, all from Marcellus. It's also 2.1 trillion. So in terms of heat content, they're equal. But Antero trades for debt plus equity 22 billion, where EOG trades for 75. Now, this is not a signal to go out and buy EQT, but it is interesting. I mean, the BTU equivalency is 6 MCF, 1 barrel. But obviously, with gas at $3.50 and oil at $70, that's like 20 to 1. Now, EOG is only half oil, interestingly enough. I mean, it's pretty diverse. It's in a number of basins, but it is half gas and half oil. So if you're owning an upstream company and you believe in gas, you believe in LNG and whatnot, there are pure gas companies, Antero, EQT, Chesapeake, they're pure gas companies. But if you're just owning an upstream company, a way to kind of play kind of if we're talking sailing up the middle rather than left to right down a windward course, EOG half oil, certainly has some advantages, even though it's trading for 3 times as much with it, producing the same heat content. I think we have to finish the 20 pages. And I think last time we got through page 18, and just before we start on page 19 and 20, I want to make a point, which I'm proud of personally, and I think Mike and Jason are proud of. There's only one company in this 20 pages, so let's say 17 pages, so let's say we average, so we have 60, 70, 80 companies. There's only one company that doesn't have free cash flow. Free cash flow defined as being after CapEx, and that's Nexterra. Now, Nexterra was considered to be the best company at doing renewable energy, wind, solar. They were going to do hydrogen. They're a very well-run company. They have a very fine utility, Florida Power and Light, within it. And they have a sister company, which they run, an MLP. And the stock's been terrible this year. In fact, if you take an index of companies that are based on renewable energy and whatnot, the index is off 40% this year. And Nexterra would be the largest company in that index. So despite the support of the Biden administration for more renewables, for, these DOE grants to promote hydrogen and whatnot, the market's judgment is that they were overpriced and, they're off 40%. And I would say 40% doesn't necessarily make them cheap, because a lot of them don't have free cash flow. So cheap represents to investors, I think, getting down to a reasonable ratio times free cash flow.
This episode of Telltales is brought to you by Top Mark Capital. They're not your typical hedge fund. They use a blend of best practices from value investing, venture capital, and private equity, which gives them a unique perspective on market dynamics. And the results truly speak for themselves. So, if you're a qualified investor who's looking for an innovative, emerging manager, visit topmarkcapital.com to learn more. This is not an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. And now, back to the show.
With that as an introduction, when we turn to page 19, these are 2 pharmaceutical companies and 2 health service companies, UnitedHealth and CVS. I'm going to make a couple of comments about UnitedHealth and CVS and then turn it over to Jason, who knows these companies and also will lead you through Regeneron and Biogen. But CVS, the way I look at it, is they want desperately to be UnitedHealth Group. Why? And then look at the difference in valuation. UnitedHealth is trading for 20 times free cash flow or 5% free cash yield, and CVS is 9 times. Now, CVS was a drug chain, and they acquired an insurance company, and they're trying to make themselves like UnitedHealth. What is significant about UnitedHealth? The Medicare, Medicaid, all kinds of problems, private insurance problems just wouldn't work without UnitedHealth. They're very good at doing all the running those systems. And look at the revenue that comes through it. I mean, it's $370 billion of revenues, and they have been a good investment. They probably will continue to be a good investment. Even if you went to single payer healthcare, how's the Medicare system going to work without UnitedHealth? So, I've never owned it. I kind of take the view that we spend 18% of our GNP on healthcare. Singapore's famous example spends only 6% of their GNP on healthcare. We have this huge budget deficit. The easiest way to fix a budget deficit is reform healthcare. Will it ever happen? The lobbying dollars involved are banks. probably won't happen. Will CVS get to the point where they're as reliable a performer as UnitedHealthcare? I don't know. I don't have a view there. Personally, I'm not really interested in owning either one of them because of this view I have that as a society, we've got to tackle the cost of healthcare. But with that, I'll turn it over to Jason to lead our discussion of this page.
Yeah, I thought you summed up United Health Group pretty well. I will just say that CVS, they were a drugstore chain. They want to be a United Health Group, but I'll tell you what they are is they're a pharmacy benefit manager. Of their $350 billion in revenue, a quarter of it roughly is their retail stores. A quarter of it is the health insurance Aetna group that they own. And half of it is their pharmacy benefit manager, CVS Caremark. So what a pharmacy benefit manager is they negotiate on behalf of the payers, so like the insurers, the price of drugs from the manufacturers. And then on the other side of the market, they negotiate with the pharmacies for what they're, allowed to charge patients, consumers for those drugs. So the idea of it was a positive for the market, for the consumer, cheaper drugs ultimately in the end. But what you're seeing is this middleman's taking hundreds of billions of dollars, taking it out of the market. And you got to think that that's going to drive up the price of drugs. They've grown so big and have so much influence. So the three biggest pharmacy benefit managers control 80% of prescription drugs. And they have so much influence in the system that they dictate which drugs are available at pharmacies, what the pharmacies will charge, and how much they get paid for those drugs. The FTC is starting to look at these businesses and saying, are they really in the consumer's best interest? I would lean that they're not. And if you think action is coming, either the market dynamics change or the FTC and the government do crack down on this, half of CVS's revenue is at stake there. And the market is kind of moving away from PBMs also. So here in California, our Blue Cross Blue Shield system dropped their PBM in favor of using a combination of a cost plus drug and Amazon to use their pharmacy and Prime to deliver drugs to your doorstep, essentially, to fill prescriptions.
And of that PBM revenue, we assume it's pretty high margin. So, right now it's about half the price on a free cash flow basis of United Healthcare. But if you were to take that chunk out, it would be, they might be negative free cash flow.
Yeah. Well, not a strong case for investing. Jason, Regeneron just always seems to be reasonably successful, but it's hard. I've watched the company for a number of years now. It's hard to really, for me anyway, to conceptualize, other than being competent, exactly how to place Regeneron. So over to you.
Yeah, we feel they're kind of priced for perfection. But a quick little aside is when the pandemic started, I was doing some consulting for a software company that they facilitated running clinical trials through a software solution remotely. So participants in the trials didn't have to go to clinics. Became very important when the pandemic started, as you can imagine. And one of our customers was Regeneron. So we helped run their trial for their antibody therapy for COVID. It was very successful. But one big takeaway out of that is they were by far the most organized and most professional team of any of the pharma companies we worked with. So if any company is priced for perfection and can rise to that bar, maybe it's the Regeneron team.
Right.
And I'll add a couple of things on Regeneron because I looked at them relatively recently. Their main product is called Ayala. It's a treatment for macular degeneration. And a handful of other conditions. It's actually down year over year revenue-wise, but they got an approval for essentially a high-dose version of that product. And so basically the bet on the company now is this high-dose version is going to be a defensive move against competitive treatments that will bring the market back to them. And the pricing's higher, so it's better margin, better for the patients because you have fewer treatments. So it'll be interesting to see how that plays out. But back to what Jason said, we think it's in general priced pretty much for perfection.
You know, Biogen's fairly controversial, isn't it? It's up and down and all over. But once again, over to you guys.
Yeah, so the big moves for Biogen are its two largest drugs are facing patent cliffs. One had a portion of its patent portfolio expire earlier this year, and then their big drug Spinraza comes off patent at the end of this year. So they're facing, a lot of competition potentially from generics there, but they have launched a new drug to potentially fill that void in sales. And it's a treatment for Alzheimer's, Leqembi, and it's an interesting story. So they partner with a Japanese pharma called Eisai, and they originally had an Alzheimer's treatment that hit the market. It was approved and later got pulled from the market. And Biogen had a pretty favorable royalty split with Eisai on that one. They were going to pay 8% royalties, I believe. And the part of that agreement was the next Alzheimer's therapy, they would split 50-50. So the first one got pulled from market, and then this new blockbuster drug is the next one. So they have a much less favorable split on the revenue there. But it is expected. I think the expectations are north of $12 billion a year in sales by 2028. And Medicare's picked it up. So it should be a large drug. But in the next 5 years, I expect a lot of competition in that kind of, in the Alzheimer's treatment, to arise.
I think we're going to have to do page 20 next week because we want to leave time for first couple of pages and news on the first couple of pages. The Apple earnings came out and were, flattish, but not as disappointing as I guess they could be. And then one thing occurred to me, I haven't talked about, Mike and I talk every morning, I haven't talked, but I mean, is there a set of circumstances where the price of Apple and the kind of flat results, and with it trading at 30 times free cash flow, or somehow Berkshire Hathaway decides to lighten up? Mike or Jason, the impact on the stock price of Berkshire Hathaway selling any other position would probably be significant. But if you were Todd Combs or Buffett himself or whatnot, how would you treat this position that they made so much money on? I noticed that Berkshire Hathaway report their market value of their securities position were down $30 billion in the third quarter, and 20 out of the 30 was their position in Apple. How would you look at it in terms of, have you made a lot of money in it? Do you just stick with it over the next 5 years, or how would you size up Apple if you're the largest Apple stockholder?
So before I answer that, I'll explain why I think the stock's held up. Because the last 4 quarters, they've had year-over-year declines in total revenue, which is, it's impressive that they trade at 32 times free cash flow, given that fact. The interesting point, though, is, especially in this quarter, is their gross margins went up pretty significantly. And part of that is because services went up pretty significantly. So the theory is that maybe they renegotiated their deal with Google, because you wouldn't expect that to have gone up that quickly. And any increase in revenue from Google would be 100% gross margin. So they do have a sort of a beautiful thing going where if hardware sales are down, gross margin goes up. So that sort of supports the flat stock price over the last year. Now, to answer the question about what do I do if I was Todd Combs or Buffett, I think I'd do what we did, is we actually sold our Apple position. And I hate selling any position, especially one that's a good company that's well run. But especially now, I think there's a lot of other things that are interesting. Fortunately, we don't suffer from the problem, the weight of the problem that Berkshire Hathaway has, is just being so big. Yeah, I say it in jest, but we don't suffer from the same constraints. There's only so many investments where you can pour that large amount of money into. So they deal with a lot of large numbers in a very different way. So, your average investor that's in an S&P 500 index fund has a pretty healthy chunk of Apple as well. So, it would take things going severely south to really affect their stock price, I think. But it would, if somebody like Buffett did start to sell, you would see it.
Yeah. I guess one thing I think about is a cell phone, and particularly an iPhone, is not necessarily a luxury item anymore. It's a necessity for most people. So that's a good business to be in.
Yeah. We have 3 or 4 minutes left. Mike and I this morning or yesterday morning, I forget which, we're talking about, given the multiple of language models that have been announced, what exactly that means in terms of how much GPUs Microsoft and Amazon and Google and Oracle have to get into their server farms. And Mike said an interesting thing, which we'll see how Jason reacts to this. Mike said, even though the NVIDIA price is high, because of free cash flow, I mean, it assumes free cash flow goes from, I have here on page 3, free cash flow at a current run rate of 40 billion of revenues, 11 billion of free cash flow. And it probably, it's 100 times free cash flow. So if you just do the rough math, whoever's paying, this kind of price for the stock is assuming free cash flow is going to go to 30 billion and be, not just go up and go down, maybe spend a little bit of time flattening out, but be pretty well established at 30 billion. Jason, Mike said this morning or yesterday morning, I forget which, that he thought price for advanced micro devices had more downside risk than the price for NVIDIA. And want to see what your commentary is on that.
It's interesting. I see where he's coming from, certainly. AMD is trying to gain market share in the GPUs for the AI space. They're making progress there. And I think some expectations are they're going to take market share, and we'll see if that pans out. The CPU side is stagnating, right? If you look at the total spend in data centers that was all going to CPU servers, the vast majority of that spend now goes to GPUs, and AMD is only going to capture 2 billion of that. I think they projected for next year, and NVIDIA is doing tens of billions. What are they? They're projecting 80. Yeah. And only like a teens in that is gaming. So call it 65 billion in AI revenue. So.
And the only way they capture that is by pricing low enough so that it's worthwhile to essentially do the heavy lifting, the software work to make it work.
Yeah. I see where he's coming from. I don't disagree with it. I think AMD is more vulnerable to other things like RISC-V coming and the hyperscalers just building their own chips rather than trying to shift off of NVIDIA to AMD GPUs. So certainly understand it. The growth is by far on NVIDIA's side.
Yeah. And I've gotten used to the term hyperscalers, but I think what we mean by hyperscalers are Microsoft, Azure, and Amazon, and I guess Facebook/Meta for its own account. In other words, the people are building data centers will start to use their own chips as compared to paying, a real premium price than NVIDIA.
Right. Yeah, they have networks of data centers around the world and at an extremely large scale.
Right. Just since everyone has macro on the mind, and since the Chinese leaders come into San Francisco, I think next week, once again, commentary from Mike, we talk 20 minutes every morning at 8:30 Eastern time. So it's pretty early San Diego time. I was commenting, how significantly will the limitations on shipping any kind of GPUs into China affect NVIDIA? And Mike said an interesting thing. He said, well, the chances are, they'll go in a big lot to someone in Saudi Arabia and then somehow find their way to Huawei or whomever in China. Jason, how trackable is this stuff? I guess, barely trackable, but how, if you're Alibaba or Huawei or Tencent or whatnot, is it feasible to get the GPUs you need kind of from the third market or, someone reselling them to you?
Yeah, I mean, I would speculate they don't even have to end up physically in China. They could be in data centers in Saudi Arabia, and then they have an agreement where, Huawei or Baidu rents the entirety of that data center, and they just do it all remote. So I think they'll get the capacity they need.
Mm-hmm. It's an interesting point because we have these, weapons export control requirements, and unlike a weapon, you don't need to physically have it anywhere. So it's another sign of antiquated laws and antiquated approaches to solve new problems.
Right. Well, that'd be a great question if someone got the Commerce Secretary or someone like that in a news conference to say, what about GPUs housed in Saudi Arabia with capacity rented out to China? That'd be a great question. Someone should plant that. See how up to date she is on how things like that could happen. With that, we'll do page 20 next week, and everyone be well and stay healthy, and we'll look forward to talking next week. Take care.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.